SAMHI Hotels is the IPO in focus, and we have Ashish Jakhanwala, CMD and CEO of SAMHI Hotels, who is joining us to talk more about the company going forward. Thank you very much for joining us, sir. First of all, I'd like to understand, just to let our viewers know that the company operates Hyatt, Marriott, Holiday Inn, Sheraton group of hotels here in India. I want to understand from you which phase of the cycle, the business cycle, to your mind, is hotel sector right now. Some say that it's coming out of a 10-year, bad cycle. So now that it's only been 1 or 2 years, then now there are still 3-4 years to go at least, because it's a cyclical industry, but this time there are very strong structural tailwinds. To your mind, how's the visibility on cycle front?
So thank you so much. So I think you're absolutely right. This time what you're seeing for the hotel sector is not cyclical, it's structural. It's basically demand supply 101. If you look for this last several years, the demand has been growing between 8 to 12%. And you can see it in airlines, office space, travel and tourism. The hotel supply is growing between 2 to 6%. Not a surprise, because the hotel industry in India has now evolved from being 50,000 rooms in 2008 to about 150 to 200,000 rooms right now. So you've seen the supply come to a level where the incremental new supply is just barely 2 to 6%. It's a fairly stable supply environment, and the demand environment is very strong and also fairly long term. So this is a structural story, not just a cyclical story.
Fair point. Also, if you can tell us how exactly is the business model of SAMHI different than the industry? What are some of the areas you focus on to differentiate your business model?
So see, we are an owner asset manager of business hotels and gateway cities. But unlike many other companies in the sector, we don't build many hotels. Our focus has been to identify underperforming, undermanaged hotels and then acquire them, turn around the whole asset through product change, bring a strong brand partner, asset management. And therefore, we've seen that we've been able to cut through that long, painful, expensive development cycles one needs to go through, and therefore a portfolio in a relatively short period of time.
Right, so this is Vinny joining in the conversation as well. You've spoken about the growth and your structure as well. What I also want to understand and what people want to know is in terms of the path of profitability for the company as well, right? Right now, you are incurring a bit of a loss. So what is that in terms of the profitability front, if you could give us an understanding for the target for the company?
Yeah, thanks, Vinny. So I think the path to profitability is fairly simple. If you know, last year, a large part of our reason for losses were really finance cost. Almost to the extent of about 570 odd crores, of which about 296 crores was one-time non-recurring. So that's done and dusted with. You will not see that being repeated. And also our leverage is coming down almost from net debt of about 2,850 crores to almost about 1,750 crores, very right. So as you see the deleveraging happening to that large extent from 2,850 to 1,750, there's going to be a significant impact of that in reduction of the finance cost. So with removal of the non-recurring finance cost, significant reduction in the recurring finance cost, our EBITDA was already at 311 crore in FY23. We continue to see very good demand momentum. So you put the last year EBITDA, you put the demand momentum on top of that, you see significant reduction in the finance cost. I think the company is well set on path of profitability with this.
One last word, I want to understand which year will it be financial year 25, when all the efforts plus reduction of debt, and even when the debt levels go down, the remaining equity gets completely re-rated by the market because your company comes in a different light, and your measures and efforts which you're taking to improve profitability, all the efforts start showing. Do you think it will be in FY25 or later?
No, I don't want to give any specific guidance, but we've gone from 172 crore EBITDA to 311 crore EBITDA between FY20 and FY23, right? So we've demonstrated very strong growth, if you see. And I think with the deleveraging, you would see a fairly rapid turnaround also on our balance sheet size. So we believe that we've unlocked the value in the P&L going from 172 to 311 crore. We'll continue to do that in the subsequent few quarters. But I think with a very large IPO proceeds going towards deleveraging, we believe that the unlocking of the value in balance sheet has also been done. So can't comment FY25 or FY24, but we believe that one would be seeing a fairly simple and a strong balance sheet as well going forward.
Right. one more thing I just want to touch upon one point is that is, you spoke about the debt, you said 1700 crores in terms of the debt, but that is still a bit high when you calculate it approximately. The debt to EBITDA comes in at around 5.5 times. So when, what is the part to reduce it further? Because, 1700 also is still going to be high. So what is that factor that you're putting in there?
So very good question. I think the IPO is really the start of the deleveraging story. What you also realize is that we have 129 odd crores of depreciation expense last fiscal year. What you would see over the next 2 to 4 quarters is that the free cash that the company generates, part of that free cash will continuously be used towards deleveraging. Part of that free cash also is going to be used towards expanding our inventory by about 600 rooms. So Vinny, what you're going to see over the next 4 to 8 quarters is a fairly rapid expansion in the EBITDA on one side because we're adding 600 rooms. And on the other side, you will also see continuous reduction in the leverage. So IPO is really the start of the deleveraging story. You would see that debt to EBITDA level fall materially over the next few quarters.
Ashish, one last question I want to understand. The incremental capex from here on, say 5 years back, how much was, say, average cost of setting up one room? How has that actually gone up in the last 3, 4, 5 years?
So for us, interesting question for us, we had actually built a whole portfolio at about 70 lakhs per key. So we've been fairly capital efficient. Part of our portfolio, about 13% of our revenues come from 30 to 60 year leasehold assets. And in that, cost per key is barely about 30 to 35 lakhs per key. So even though we own or lease most of our hotel assets, you've seen that we've been fairly capital efficient. And we've not really seen, because we're not building hotels. See, when you're constructing hotels, you're dealing with commodity prices, cement, steel, labor, and therefore you cannot really beat that inflation. When you're buying assets which are underperforming, undermanaged, you're effectively paying a price for that undermanagement, underperformance, and the value that you get is of a stable, good quality hotel. So I think that price to value ratio has not really changed. It continues to be squarely in favor of companies like ours. And two, as I said, our capital efficiency has been pretty good. We were 70 lakhs per key pre-pandemic overall. And just for the leasehold assets, it was just about 30, 35.
Excellent, Ashish. Great chatting. Looking forward to interact with you more often from here on, now that your listed journey will start. And of course, it's a multi-year cycle. So we all are actually, we love your properties. I personally stayed at some of them, and I'm a good
Thank you so much.
admirer of your brands.
Thank
you very much for your time this afternoon.